For instance, Bank of America recently found that small business hiring fell by 7%, and even Jerome Powell recently admitted that both supply and demand in the labor market have come down so sharply so quickly. Or I guess put another way, since the government shutdown delayed some very critical employment and economic reports, some for the first time in 12 years, the Federal Reserve is using alternative data to help guide how much and how fast they lower interest rates. And those reports are overwhelmingly showing that unemployment is increasing, layoffs are becoming more common, and lower rates might help stabilize the economy. Although in terms of the rest of the market and how this is likely to affect your money directly, here's where things get very interesting. The stock market. Look, on the surface, despite every pessimistic headline, objectively, the S&P 500 has done incredibly well in 2025. I mean, let's face it, we're up more than 30% from the April lows, and over the last 5 years, we've pretty much doubled in price, which is essentially the equivalent of getting a 15% annualized return every single year. But in terms of whether or not this is sustainable, here's what I didn't expect. Both Bank of America and Morgan Stanley now predict that we could see another 8% increase throughout 2026, bringing the S&P 500 to a whopping 7,200. Why? Well, as they say, corporations will continue earning a lot of money, AI will broaden throughout the rest of the market, and productivity will increase. However, others have pointed out that above-trend growth like this usually isn't sustainable, and that long-term, we'll see smaller returns as the market begins to balance out. For Goldman Sachs, this translates to just a 3% annualized return over the next 10 years, compared to JP Morgan, who previously predicted that we'll see a 6% annualized return. Of course, not everyone agrees with this, with Datatrick saying that while the stock market has endured decade-long stretches